now we'll turn our attention to our relative valuation models using multiples. And our common price multiples are price divided by earnings, price divided by cash flow, price to sales, price to book value. As I mentioned in a prior segment, easiest way to think about these is how much am I paying per dollar of earnings? How much am I paying for dollar of cash flow or per dollar of sales? Price to book value, well, we really just look at the ratio there, and we'll touch on which circumstances this might be the appropriate model to use. So what are the advantages of this? Well, they're widely used. Everybody talks about price-earnings ratios. They're easy to calculate and readily available, and we can use those for cross-sectional, comparing firms at the point in time, or we can use time series, looking at what the price-earnings ratio, for example, has been for a stock over time and saying, well, it's at the high end of its range, or gee, its PE has never been so low, things like that. And there is an association between some of these multiples and equity returns in the future. And these multiples we've got here can be historical or forward-looking. Sometimes when you're given a PE, it's based on last year's earnings. So the price now based on the prior year's earnings. Or we can also divide by the expected earnings for the coming year, E1, and we get a forward-looking price-earnings ratio. And we can use these for, I mentioned that cross-sectional or time series analysis. For our PE based on fundamentals, we're going to relate this dividend discount model to the PE. So what we're really answering here is the question of, well, if the stock were valued according to this dividend discount model here, the constant growth model, what would the price-earnings ratio be? So rather than looking at the PEs of other stocks, we're looking at this stock, so maybe we can compare the PE in the market to what we think this justifiable or fundamental price-earnings ratio would be. Now the mathematics is very straightforward. We start and say, okay, if the stock is valued like this, then let's just divide both sides of the equation by next year's earnings. And so we divide P0 by that, and we get this leading or forward-looking price-earnings ratio right here. And what we end up with in the numerator is our dividend payout ratio. The dividends we expect next year divided by next year's expected earnings. So that's the dividend payout ratio, and so the dividend payout ratio, the required return on equity, and the constant future growth rate all enter into this fundamental PE. So the primary determinants of the PE ratio, when we look at this, we can say, well, the required rate of return, the growth rate, and the same factors that affect a stock's price affect its PE ratio. Higher growth, higher stock price, higher PE ratio. Lower required rate of return, okay, higher stock price, higher PE ratio. Now, other things equal, and that's important, and you should look for that in questions. When you see other things equal, that means we can change one variable and just ignore the others. We'll just keep them the same. Okay? So, if the others were unchanged, then a higher dividend payout ratio, a higher growth rate, or a lower required rate of return would all lead to a higher PE ratio and higher price. But note that increasing the payout ratio will decrease the growth rate. Remember, our formula for our constant growth rate in the constant growth model was return on equity times this retention ratio, 1 minus the payout ratio. So if it doesn't say other things equal, or if we're talking about a real-world application, we can't just go to a company and say, well, increase your payout ratio, that'll increase your stock price, and that'll increase your PE. Well, that just can't be the case, because in that case, all firms would have a 100% payout ratio to maximize their stock price. But the reality of it is our growth rate is going to go down if our payout ratio goes up. So if it doesn't say other things equal, we can't really say increase the payout ratio, that'll increase your PE. Other things equal, that's true. But when we look at the interaction between our variables here, it may be true, it may not be true. So let's do a numerical example here. We expect a firm to pay out 30% of its earnings as dividends. Earnings and dividends are expected to grow at a constant rate of 6%. You require a 13% return on equity, return on the common stock. What is the stock's expected PE ratio? And it's just as easy as it seems. We're going to put that payout ratio in the numerator and then K minus G in the denominator, and our PE ratio here is kind of low. It's 4.3 times next year's expected earnings. So when interpreting a PE, let's take a look at this chart here. We've got the dividend payout ratio, the sales growth rate, and total debt to equity for a company and for the industry average. So we're comparing it to a peer group here, an industry peer group. Which of these factors support the company having a higher PE than the industry? Well, higher payout ratio, higher PE. Higher sales growth means higher dividend growth and higher PE. And higher debt means higher risk. Now, when we have more debt in our capital structure, we may have higher expected earnings, but we also have more volatility of earnings because of the financial leverage. And so that greater uncertainty or variability of earnings means we need our required rate of return on equity will increase because of that increased uncertainty. So here's our price multiples: price to earnings, price to sales, price to book value, and price to cash flow. We can use operating cash flow there, or we could use free cash flow. Either way. Now remember, you don't have to just pick one of these as an analyst. Why not look at them all? What's an extra 5 minutes when you're trying to value a stock and write a research report on it? So we can look at all of these, and if they're all consistent, pointing in the same direction, great. If they're pointing in different directions for the stock, that is, some suggesting undervalued, some suggesting overvalued, then the analyst needs to dig a little deeper and find out what's going on and which one may be the predominant effect there. Now the price-sales ratio, when earnings are negative or just they're unusually low, sometimes that's a good thing to use and compare it to the price-sales ratio, either historically in time series analysis or cross-sectional, comparing it to what other firms doing. I remember at one point stock 7-Eleven, the convenience store operator, very low or negative earnings. And of course its price-sales ratio, because the stock price was down, looked very low. We weren't paying much for $1 of sales. And kind of the thinking that went into that trade is that, well, they've got a good franchise, they've got good real estate, they're a well-known brand name. If they could just operate with a regular return on equity, we'd have some earnings. So when they got it together, maybe got some new management in there, or somebody had to buy the company out and change the management, if they could just get to a reasonable return, if they could just make 5% on sales, earnings would be this and the value would be this. And as it turned out to be a good trade because they did get back to profitability, and the fact that they were at a very low multiple of sales just said, well, if they can make any kind of reasonable return on sales, then we've got some real value here. And now we talk about using price multiple comparables. And the idea, and we've been mentioning this all along, it's just based on the law of one price. If these two firms are identical they're comparable firms or comparable assets. If they're really close, they should trade at the same multiple. So you see stock reports that say, well, this stock, they've got this debt compared to the industry, they've got this growth compared to the industry, they've had this performance relative to the industry. Gee, why is their PE lower than the industry average? We think this stock is a buy. Well, that stock is a buy on a relative basis if the analysis is correct. So let's look at some price multiple examples here. And first off, whenever you get one of these tables, I like to draw an arrow that tells me which way time is going so I don't get it backwards, because these tables can be presented either way. Could be 2000x1 on the left and 2000x3 on the right. So if we look over time going this way, we see a growth in shareholders' equity, we see net revenues growing, we see net income growing rapidly. It looks like cash flow from operations is up, stock price is down, and shares outstanding have grown somewhat, about 10% here in this year. So we should calculate the PE, price to cash flow, price to sales, and price to book value for the company. So first, we've got to state earnings, cash flow, sales, and book value on a per share basis. So there we've got it on a per share basis. Our equity per share is going down because of the share growth, right? We had, if we go back, total shareholders' equity, we saw it increasing, maybe slowly, but increasing across there. But the share count is also increasing. So when we put everything on a per share basis, we see a little bit of decline here, a little bit of decline here. Net income per share has gone way up. Operating cash flow per share is marginally up, and the stock price is down. So next, calculate our ratios to share price. And we see these ratios pretty stable. Price to book value, pretty stable. Price to sales. Price to earnings, gone way down from 120 down to 16. Price per cash flow, down a little. So comparing 2000x3 industry averages and determining whether the firm is undervalued or overvalued. So now let's take a look at these current ratios and compare them to the industry average. Okay. Well, their price to book is very low, price to sales is very low, price to earnings, a little bit higher than the industry average, actually double the industry average there, and price to cash flow is low. So there's our comparisons at that point in time as of the end of 2000x3. And so we get suggestion that we're undervalued in 3 of these, and the price-earnings ratio, as we noted, is higher than the industry average. That's overvalued. And so that's the start of our analysis, and now we want to know, are earnings going to grow? I don't think we can expect the industry average to increase from 8.6 to 16. So in order to justify this, we'll need some growth in earnings. It says here, the PE ratio suggests an analyst should examine reasons why the company's earnings might be depressed. So high depreciation, taxes, interest expense, some write-offs, impairment charges, losses. Maybe some of that's temporary. You can see better numbers in the future. Now this third one, I guess it's the second one in relative value after all those taken as a group. Enterprise value to EBITDA. And we're going to define enterprise value as the market value of the common stock plus the market value of the debt. So this is the market value of all the outstanding claims against the company. And then subtract out cash and short-term investments. We use this often. It's used in private transactions, not public companies. And they say, well, how much? If we bought up all the common stock and the debt, but then once we owned the firm, we could get our hands on the short-term cash, or the cash and short-term investments to help finance this purchase, how much would it cost us? So we kind of think of this as a takeover value, a buying the whole company value. So EV represents the total market value of the firm, and then we've backed out the cash that we'd receive if we, or at least have control of, if we bought the firm. And this earnings before interest, tax, depreciation, and amortization, this is the total earnings available to both debt and equity. One of the advantages of this is that we can compare companies with different capital structures because we've taken out the interest on debt and the tax effects of debt. And so two companies that have noticeably different capital structures, when we took that debt part out and just looked at the overall enterprise value, debt plus stock value, and then the earnings without the effects of financing, then we can compare firms with different capital structures. Whereas with PEs, remember, if we had different debt, we had higher variability of earnings and all of that, so they weren't really comparable. So these ratios are useful when firms have different capital structures. As I mentioned, if earnings are negative and the PE ratio can't be used because negative PE ratios just don't tell us what we need to know when earnings are negative. So let's look at a numerical example here. We've got a stock price of $40, shares outstanding, so there's the total market value of our stock. Market value of long-term debt, book value of long-term debt, book value of total debt and liabilities, cash and marketable securities, and then we get down to EBITDA down here. Now, what do we want for the numerator? We want the value of the outstanding common stock, and we've got that there. We've got a little bit of trickiness coming up with the debt because we want the market value of debt, not the book value. So we're not so interested in the book value of long-term debt. We want to use the market value of long-term debt. Now, we've got the book value of total debt and liabilities here. And the little trick we're going to use is we're going to say that the book value of long-term debt and the market value of long-term debt may be pretty far apart, because when interest rates change, present value of long-term debt, the market value can change quite a bit. But shorter-term debt, not as affected by changes in market interest rates. So here, even though we don't have the market value of short-term debt, we're going to take the total book value of debt and liabilities. We're going to subtract out the book value of long-term debt, and in that way we're going to get the book value of short-term debt and liabilities. And then we're going to use that instead of the market value because we don't have it. And then remember, we're going to back out the benefit of the cash and marketable securities that the firm holds. So step one, determine the market value of short-term debt. Okay. So that's the part where we take the book value of total debt and minus the book value of long-term debt and estimate the market value of short-term debt as its book value. So now we've got $1.2 million for that. Once we have that, we take the market value of total debt. So we're going to take that book value of short-term debt, market value of long-term debt, add them up and get $1.8 million. Market value of equity, simply the share price of 40 times 200, so that's $8 million. So now we've got our pieces together. For step 4, we're going to add the value of debt, the value of equity, back out the value of cash, and we get an economic value of enterprise value of $9,550,000. We can divide that by our EBITDA of $1 million and get 9.6. And so then we can compare that to competitors, industry average. But oftentimes when you're reading research report, they'll look at private market transactions too and say, well, these savings and loans, these last couple that have sold at enterprise value multiples of 3.1, 3.2. And so you can compare the valuation in the public markets to transactions that have taken place in the private market and gain some insight using that. And lastly is our asset-based models. And this is kind of, at least it's presented as kind of a floor, right? Because the idea of a company, if it's an ongoing profit-making enterprise, it should be worth more than simply the fair market value of its assets, right? The idea of a company, let's put some assets together that cost 20 million and see if we can't build a company with earnings power that gives it a value of 30 million. That's a successful investment. Analysts usually adjust book values to market values. That is, your book value for your assets may not be the fair market values. Well, that step in itself can be very challenging if you've got a factory to value. And that's because we're looking at an asset value, what we could sell it for. We're not looking at the value of the earnings stream that it produces. So in that sense, asset-based valuation models provide a floor value. One caution, just as an aside, these asset values are not fixed. If things go really bad in an industry, then those factories, machinery that produce the output in that industry, their values can fall as well, especially if those assets are not easily applied to another industry. If they're very specific to the industry that's in a downtrend, then those asset values are going to fall as well as earnings and other metrics. So let's just take a look at an example here. A firm has 2,000 shares outstanding. Market value of net fixed assets is given, 120% of book value. And then we've got some accounting numbers here. Assuming market value equals book value for liabilities and short-term assets, calculate net assets per share. Well, this is just back to our accounting. So we start with a market value of all the assets, okay, 1.2 times book here. Market values of liabilities, adjusted equity value per share. So we did this based on our estimates of the fair market value of the assets. The liabilities, well, those are a little more certain in most cases. If we've got a liability, we've got to pay a certain amount in the future, well, that's what we've got to pay. But getting these asset values is through an appraisal process or an estimation or looking at private market transactions or any of that is still subject to error, I think would be the best way to put it. So our present value models, our discounted cash flow models, the advantages, we said they're theoretically sound. They're widely accepted. But those inputs must be estimated, that KE, that constant growth rate G. And valuation can be very sensitive to input values. Say in our denominator in D over K minus G, think about a dividend of $1 and K is 10% and G is 4%. Well, we've got 1 over 0.06. Now, what if we were wrong about that growth rate? If we were wrong about that growth rate and it's 2% rather than 10%, then we get 1 over 10 minus 0.02, and so our valuation is $1 over 0.08. I tried to make it 2 here for you and tried to make a 0. There we go. And so that difference, instead of dividing by 0.06, we're dividing by something that's 33% larger, 0.08. That difference in values can be really large just based on the small changes. And when K and G are close together, it's even more sensitive to changes in our estimated constant growth rate. For the multiplier models, they're widely used. The claim here is that they're associated with stock returns in some some way that's useful to analysts. A little different conclusion than we got in our market efficiency reading, but we'll ignore that for the moment. Easily calculated, good for identifying attractive companies, perhaps, according to the curriculum, yes. Useful for time series or cross-sectional analysis. What were the disadvantages? Well, if we've got different accounting methods, we've got to fix that up to make them comparable. And for cyclical companies, these multiples are highly variable. If we've got, let's say, auto industry has typically been cyclical. So during the bottom of the recession, earnings are really low, PE ratios are high. And then at the top of the cycle, because the market anticipates and knows it's a cyclical company, our PE ratios are going to be low. So maybe the market's at a 16 PE, but the auto companies, even though they're doing quite well, if the market thinks that's peak earnings, their PEs may be down around 7 or 8. For the asset-based models, they can provide floor values. They're useful for firms with mostly tangible short-term assets or if the firm's going to be liquidated. Well, if it's going to be liquidated, that's clearly your best guess at the value per share. And when we say tangible short-term assets, if we look at financial services firms, financial firms, when their assets could be more easily valued because many of them are traded. Okay, if it's a loan portfolio, we know the quality of the loans, we know the interest rates on them. Fairly easy to value those assets. So some of the disadvantages, ongoing firm value may be greater than asset value. Well, yes, we're going to use asset value when we're thinking about liquidation or a firm in financial distress. Fair values of assets, as I emphasized, can be very difficult to estimate, especially with primarily intangible assets or in the presence of inflation. So intangible assets such as, well, intangible assets actually on the financial statements, okay, might be a purchased patent, might have goodwill as an intangible asset that we find on the balance sheet. And this can be a little bit problematic in estimating the true values of those. So in choosing a valuation model, well, what are your available inputs? Do they pay a dividend? Okay. Based on the intended use of the valuation, are we looking at a takeover value? Are we looking at a value of a comparable company? Okay. Are we just going to make a small investment? Are we thinking about shorting the stock? What are we using the valuation model for? More complexity is not necessarily better. I mean, the fancier the model, and they can tell you, and you come out and you say, yes, each share is worth $32.16. Well, take that with a grain of salt, okay? Just because it's complex and we've spent a lot of time estimating the required return on equity, not necessarily better. Consider values using more than one method. I'll put a big check mark there. I'm a fan of that. Why not? Let's look at all the different methods. If you're getting overvalued with one method and undervalued with another, I don't think you want to make an investment until you can reconcile those two and understand why they're different, what each one is telling you. Consider the uncertainty about your input values. Remember, we've talked in the past about having a range of values that you're pretty, have some confidence in, rather than an actual point estimate, which you're pretty sure is going to be wrong one way or another. And consider the uncertainty about the model's appropriateness. That is, that the characteristics of the firm fit the model that you're using.